Good afternoon from StablePoint Partners. Claire Smith here, and after a long week of volatility in the markets, I'm here to give a synopsis of the current environment, some historical context, and also our thoughts moving forward. So yesterday, the S&P 500 officially moved into correction territory, as well as the NASDAQ in a deeper correction. As a reminder, what is a correction? It's a 10% decline from the previous market high. We all are aware this is namely a factor of the Trump tariff announcements and escalating trade tensions, but it's important to be clear that the market is right now reacting poorly to the policy uncertainty, and it's not so much anchored as much in economic fundamentals. So having some clarity around policy will definitely help provide some relief from this volatility that we're seeing. Actually, experts are calling this a healthy reset to more normal valuations long term. And we agree, not to overreact to the current sell-off in equities. We actually came into this period with the market being fully priced, fueled by the massive amounts of tech spending. So some of this is a natural correction in the market, and of course some is attributed to the impact of tariffs. There have been revisions to GDP growth, but most experts have discounted the risks of a recession. So when we reference a natural correction, we mean that this is common in any given calendar year or throughout a market cycle. So to quantify, you will see up here this very busy slide that is essentially showing that the average decline in the S&P 500 in any given year is about 14%. And despite this, over 3/4 of the time, the year ended with positive returns. And the second busy chart is also very helpful context. What it's displaying is that going back all the way to World War II, the average recovery after a correction takes just about 4 months. Again, a correction being a 10 to 20% pullback, the average time to rebound is 4 months. So the message here is that corrections can occur swiftly, so staying invested helps investors not miss those market rebounds. Naturally, we use the S&P 500 as a benchmark, and we have discussed in great detail the concentration and top-heavy nature of the index. For context of the recent pullback, the Magnificent Seven stocks have seen a significantly higher pullback than the rest of the 493 stocks in the index. Additionally, the Dividend Aristocrats Index, we talk about this a lot. This is the index of companies with long histories of strong dividend payments, has only dropped less than 2% in the same time period. Today, as of even this morning, we're also seeing stocks pointing higher after avoiding a government shutdown. So we've been really emphasizing utilizing a diversified approach to client portfolios. This is nothing new, and we are paying close attention to everything going on and continue to remain quite optimistic based off the notions that I reviewed today. There also will be more to come from StablePoint Partners Chris Griffith and Henry Wheelwright, who have been attending the Barron's Investment Conference this week. They look forward to sharing their takeaways from discussions with industry leaders next week. Thank you. Have a wonderful weekend and happy St. Patrick's Day as well.